Hey, good morning, everybody. Bob, Trade Genius, 28th of July. Hey, first I want to say is for those who are just joined us from the special from yesterday, is if you need to get set up on the moneymaker or things of that nature, just email Matt, tradegenius101 gmail.com, and he'll take care of anything that's open item for you first thing on Monday. And we're glad to have you there. And it's going to be a really exciting week. I think there's a lot of things in motion here. And that's what we want as traders. So we want the volatility so that we can make money. And the one thing I want to show you guys, and this is for people who aren't subscribing yet, this is the opportunity that you're going to profit from if the stock market starts to roll over hard. Not saying it will, I just want to point out to you the opportunities, because a lot of people get frozen when the stock market starts to get hinky, and there are definite opportunities. And one of the things that I tell people when they ask me about, ultra ETFs, is that my rule is never go long ultra ETFs. It's basically a death wish, because it's hard to trade it. I know it looks good when you look at from the back and you see, wow, look how much money these people made because it went up. But in real time, you don't really know if a trend's going to sustain or not. And these ETFs tend to chop a lot. However, the way to make money with ultra ETFs is to buy puts on those as they get overbought and they get a sell signal. And that's one of the things I want to show you right now. So this one here is a UYG, and you can also use FAS if you wanted to, and if you don't want the leverage, you can use XLF. And so what I want to show you here is, and I'll zoom in too. So this is before the great financial crisis. So you had, and I have this on a weekly, so I'm sorry, this is not important, it's the levels that are important. So up here in May of 2007, the financials started to get a little wiggly, all right, and they topped, and this is an ultra, so you're gonna get 3x the move, and so from basically the summer of 2007 until the crisis bottomed in March of 2009, this ETF lost 99% of its value, and you can get puts on this. And so this is one of the things that I traded during the GFC. Real estate was the other one, but we're too early for that, because these first rate cuts are gonna be kind of positive for real estate, and then they won't be. Okay, so right now financials are the best one if they start the rate cut cycle, and that's why I'm talking about it today. So you can make a lot of money trading this this instrument on the short side, and then you can use the moneymaker or stochastics to determine your buy-in areas. Okay, so I just wanted to point it out. That is a lot of money. Okay, and if you just invested 10 contracts and you just rolled it, this alone probably would have made you, you had some bumps in the night, you'd have lost some money, but you would have easily on $2,000 or $3,000, you would have probably made $60,000 or $70,000. Okay, there were some days where we were swinging in these markets. We were making $20,000, $30,000 a day just with options. I mean, just with 10 contracts. That's how crazy this gets with these ultras. You just got to be quick and jump out and then take the next one down. But that's what kind of money you can make trading these things. And that's what I want to start talking and educating people on how to do this, because this is what's going to happen. Volatility is going to pick up, and I'll show that to you in a second too. And once that happens, then you're going to be in a position to do really well shorting these overbought ultra ETFs, because when people get scared, they start bailing out. So let me zoom in for today, and let me go down back to a daily chart here and what we're watching for. Go auto here. Okay. So right now, when trading these, timing's everything. You could be a little bit late on these things, but you don't want to be early because you just don't know if you're going to get squeezed. Is that so? When it hit the bottom of the channel here in June, um, it started moving up here from 42 to 48. So this is this is a 15% move on this thing in a month in financials. All right, but it's not. Let's see here. Go to here. It's just really basically topping out. And the nice thing about these triples is that they have what slippage is. So you have to do better every time to keep rising. So you have the headwind of the ETF that works in your benefit. So what I'm looking at here is that I'm waiting for the red to cross down over blue, okay, and then ideally I'd like to enter there. I'd love for it to get up to around here if it's going to do it for me, or fail here, and then I'm going to enter puts. Okay, and then you have some options on what you wanna do there, and then here's UYG, and if you just wanted to sit on these things, okay, and look for maybe a double or a triple, I would go back down and I would look at like the 42, okay, or even the 43 on December on a sell signal, and let the price come to you. You have a thing called gamma, which basically, like the Doppler effect, as price comes to your strike, it becomes accelerated in value, and that'll force even more selling. And so that's what I'm looking at. I don't know if I'll go to December or if I'll do September. It all depends on what Powell says in his follow up to the rate decisions. So, and for me, I'm not going to front run it. I'm going to actually wait for that crossover. I don't care if I'm a day or a couple points behind, because the momentum's coming out of financials as soon as they start rate cutting. It's one of those things that is a truism, okay? And this is where money leaves because of the compression of the interest rate spread, and also people refinancing their loans, and they're able to then take out less money or whatever it is, and then the mortgages get refinanced, and on it goes. And then also it's a precursor to a recession normally, and that also then dries up credit. So it's all bad news for banks. And so that's what I'm looking for here, and this is the opportunity. If you look at September, August is a little too quick for me, but even if you did September, you'd have to get a little bit closer. I'm willing to risk $1,000 on this trade, and if I go September, I'll at least be able to maybe stick a hedge in there for August if it doesn't really start to move. And so I think this is going to be a great trade for us. So let me shift gears here on you, and I want to show you VXX. We normally trade this from the short side, and I'm not suggesting we're going to trade it at all. I'm just going to show you that there's starting to be some divergence there, and by the way, this is the best trade you could take. Okay, every time you get an overbought condition in stochastics, it's just money in the bank, death taxes and short volatility, and it works 90% of the time. And then you get these huge blow-ups in volatility, and then after that you're back on the horse again. It's the way the financial system's set up. You get to participate in this, and so we'll talk about that when it's time to do a macro VXX or UVXY put trade. But right now, what I'm looking at here is, as prices have been falling, is that you're starting to see a increase here in the stochastics, and that's a divergence, and that's something for people to think about. And then yesterday I pointed out the VIX VVIX trade is the 1 month for the 3 month has got down to 0.8. And whenever it's gotten down that low before, that's the difference between the current futures for volatility and the futures 3 months out. That means that it's getting to a point of what's called ridiculousness, and that usually those things then tend to come back into the mean. You get a reversion to the mean, and that means volatility is going to pick up. And so many people are short that when that happens, it's usually an explosion higher, and you just want to stand out of the way. And then usually it's a carry kind of a trade, which means that people are leveraging stocks because they're looking at volatility, and risk managers around the world start saying we got to pull back on our exposure because volatility is rising, and that's what our compliance officers require of us, or our risk officers require of us. And then it becomes a self-fulfilling prophecy. So those are the things I want to talk about. I am unsure what the Fed's going to do, to be honest with you. I mean, I've gone anywhere from no cuts to 50 basis point cut. The data is really muddled right now, but most of it's backward looking. I think they're really, really, really concerned what's going on with the in China and what's going on in Europe. And the Europeans are all in, okay? And I mean, they're almost all negative rates over there. And that's a problem for us because our rates are not. We have the highest rates in the world. We're the best economy of the world with the highest rates in the world. And that becomes problematic. The Chinese are making noise about cutting rates too. And what we're really worried about is the Chinese actually devaluing their currency. Last time that happened, we dropped 18% in 6 weeks. And I know everybody's watching that. And the Fed particularly, because Trump will be all over them if they blow that move. So they may want to preempt the Chinese move as well. So any of those three scenarios, I wouldn't be surprised. I think the 50 basis point scenario probably has the best chance of giving an initial bump in the market. But then I think everybody is going to take a breather and start worrying about what that means. But anything less than 50 basis points, we're going to get a sell-off. And then I think the financials are going to be in trouble regardless. So anyway, thanks for letting me ramble. You guys have a great day. For anybody new with us, just get in the chat room. We're in there all the time, and we'd love to get to know you, help you find out what you're trying to trade, and point you in the right direction, whether that's crypto, ETF stocks, or trading futures and Forex with us. Catch you later. Bye.